Assalamu alaikum wa rahmatullah. Dear students at Faculty of Commerce English section, first year. Today we will continue our measures of income. So, in last section, we talk about the gross domestic product, and it's a very important measure of income. We have other measures of income like net national product, and it's a total income earned by nation's residents. It's gross national product minus the depreciation. So we will have a net value. So here we have net domestic product, and it's equals to the gross domestic product minus depreciation. So we will have a net value, we exclude the depreciation. If we want to calculate the net national product, we must exclude the depreciation from the gross national product. So we will have a gap between the gross domestic product and the net domestic product. This means that we have a larger share of depreciation. So we will have a less gap or narrowing the gap. This means that we have improvement in capital stock. So these are other measures of income. We have net national product, we have net domestic product. Net national product, we can obtain it from the gross national product minus depreciation. Net domestic product, we can obtain it from gross domestic product minus depreciation. So here is an example. An economy in 2008 produced 500 billion worth of final goods and services. Of these, we have 70 billion were investment goods, and we have 25 billions of capital stock in existence at the beginning of 2008 was replaced or repaired. So, in order to get the net domestic product, the net domestic product, here we have gross domestic product 500 billion. We have 70 of them investment goods. We have 25 billion of capital stock in existence at the beginning of the next year. So in order to obtain the gross domestic product, we exclude the depreciation. In order to obtain the net national product, we exclude the depreciation from the gross national product. So here, because if we have 25 billion like depreciation, we exclude it from the 500 billion and we get 475 billion. And we continue for our other measure. We have the national income. And the national income is the total income earned by a nation's residents in production of goods and service. So we here has a focus on nation's residents, السكان المحليين. And the national income, we can get it abbreviation NI. This is the national income. We have a difference between national income and the net national product. If we exclude the indirect business taxes and include the business subsidies, this means that we have national income. So national income is net national product minus the sales taxes. So here we exclude the taxes and we include the subsidies if we had subsidies. For personal income, it's the income that household and non-corporate business receives. الدخل الشخصي هو الدخل الخاص بالهاوسهولد، السكان المحليين أو القطاع العائلي. We here exclude the retained earnings، الأرباح المحتجزة نستبعدها من ال personal income. So personal income is the income that household and non-corporate business receives for the returned earnings أو الأرباح المحتجزة. It's the income that corporation have earned but haven't not paid out to their owners. So this means that the company didn't share these earnings, which make it return earnings. Why companies has returned earnings? In order to grow, in order to open other branches, all of these examples. For personal income, it's the national income minus earnings. So personal income is the national income minus earnings. Disposable personal income, it's the income that household and non-corporate business have left after satisfying all their obligations to the government. What kind of these obligations? It's the taxes. So if we wanted to calculate the disposable personal income, we had the personal income minus personal income taxes. Personal income taxes, it's like the tax payments for the residents. Here we had the income approach. In the other sections, we focus on the expenditure approach. Here we focus from the income side. And income side, we had different approaches: aggregate income, national income, and personal income. For the aggregate income, it's the most common income approach. So the most used approach in order to calculate income, it's the aggregate income. Aggregate income is calculated by adding all labor income, and we have different income like wages, salaries, and benefits. And we also add the capital income, interest, profits, and rent, depreciation, indirect business taxes, and net income of foreigners. These all are aggregate income. For the national income approach, it's the total income earned by citizens and business within a country during 1 year. It's a summation of labor income and capital income. And here we are excluding the indirect business taxes, we exclude depreciation and the net income of foreigners. Because here we focus on the citizens or residents of this country. Last approach, it's personal income. And in this approach, we use the total income paid directly to individuals. What type of this income paid directly to individuals? It's like the capital income, labor income, or transfer payments. We had other approach here, production approach, or it's called value added approach. Production approach is the total production of all firms or industries in economy. Here we had avoiding the double counting by only adding the value added by each manufacturer. So for each stage, we add once the value added. So if we have 3 stages, we only add the value added. If we here we had $100, then here we add 120, Here we add 50. So when we had the summation of these three values, we can obtain the value added of all these sectors, and we can calculate the gross domestic product by production approach. So we continue to have the unemployment and its natural rate. This is unemployment and its natural rate. Unemployment, we can use it into two categories. It's the economy's natural rate of unemployment refers to the amount of unemployment that the economy normally experiences. This means that the full employment, it's not meant to be 100% employment, but it's the level of employment corresponds with the natural rate of unemployment. This means when we have full employment, this means we don't have no cyclical unemployment. So we must focus on this part. Here we had a full employment. If we have full employment, this doesn't mean we had 100% employment. This means that we can have some kind of unemployment percentage. But at full employment point, we only had the natural rate of unemployment. We don't have cyclical unemployment. Cyclical unemployment refers to the year-to-year fluctuations in unemployment around its natural rate. So التغيرات أو التقلبات التي تحدث في معدل البطالة حول المعدل الطبيعي تعني بطالة دورية. Here we know who measure the unemployment. What kind of business that is interested in measuring the unemployment. In United States of America, we use the Bureau of Labor Statistics, or BLS, which makes surveys for household every month. In order to measure the unemployment, the BLS places each adult who is 16 or older into three categories. We have three main categories, which is employed or unemployment or not in the labor force. So if some citizen that has an age of 16 or older, he has the opportunity to be employed or not employed or not in labor force. And we will know more about every one category of these three categories. For the labor force, it's the total number of workers, including the employed and unemployed. So we have two types of people, which are employed and unemployed. So the labor force, it's the summation of number of employed and number of unemployed. Unemployment rate is the percentage of labor force that is unemployed. So for unemployment rate, we have number of unemployed divided by labor force multiply 100%. So for unemployment rate, it's the number of unemployed divided by labor force multiply 100%. For the labor force participation rate, it's the percentage of the adult population that is in labor force. Labor force participation rate, it's equal to labor force divided by adult population multiply 100%. So first, we can obtain the labor force from number of employed plus number of unemployed. Then we can calculate the unemployment rate of counting the number of unemployed and dividing them by the labor force, which includes the number of unemployed and the number of employed, and then we multiply it by 100%. And then we can obtain the labor force participation rate by dividing the labor force over the adult population multiply 100%. And then we can know how to measure unemployment. And here we have a numerical example. And this example in 2001, there were 135 million employed people and 6.7 million unemployed people. If you want to calculate the labor force, we can obtain it from the employed people and the unemployed people. For the unemployment rate, we can divide the unemployed over the labor force, or the number of employed plus number of unemployed, multiply 100%. This means we have unemployment rate of 4.7%. What if the adult population was more than the labor force, which is mean it's equal to 211.9 million? This means the labor force participation rate equals to the labor force dividing by the unemployment rate multiply 100%. This means we had a labor force participation rate of 6.9. And then if we want to know the various subgroups of the US population, we had women have lower labor force participation rate than men. And even in the United States of America, we had that the blacks have similar labor force participation rate to whites, but they have higher rates of unemployment. For the teenagers, we have lower labor force participation rate, but higher unemployment rate. Of course, because teenagers have no experience, and also for black and women, as they are treated as special subgroups of US population. And here we take the business cycle before, and we know that we have a peak of business cycle and we have recessions time until we get to the trough, and then a recovery and peak again, and so on. And this is the business cycle, which has 4 phases. But for the business cycle, it also have a growth rate trend. This is a growth rate trend, and here we have an x-axis, we have time, y-axis, we have the level of real output. So the natural rate of unemployment is the normal rate of unemployment around the unemployment rate fluctuates. The cyclical unemployment is a deviation of unemployment from its natural rate. So here we take the cyclical unemployment, and it's about the deviation of unemployment from its natural rate. The natural rate of unemployment is the normal rate of unemployment around which the unemployment rate fluctuates. Thank you for listening, and we will continue in the next section.